Welcome back to EDS, and in this video I'm going to show you how you can generate consistent returns year on year by writing options contracts. Whether you've got a small account, large account, I'm going to show you exactly what you need to do. The first thing that you want to do is open up any equities underlying. It doesn't matter which one. We've got NEO open at the moment. It is New Year's Day today, by the way, as well, 2025. Happy New Year to everyone. And we simply want to navigate over to where we can see a list of expiration dates for that particular underlying. All equities have the same expiration dates, which is why it doesn't matter which one we choose. We're just interested in the expiration dates themselves. And the expiration date that we want to pick needs to be between 30 and 60 days out in time. And it also needs to be a monthly, not a weekly or quarterly expiration date. Now, the only expiration date that actually fits that criteria right now is February 21st, with 51 days left on the contract. So we can take this information, 51 days, come over to our watch list, and we can simply filter out any and all underlyings that have an earnings event over the next 51 days. Now, the purpose of this is to avoid volatility expanding or increasing whilst we're in the position. Leading up to an earnings event, volatility will typically increase, and options prices increase when volatility increases or implied volatility increases. Now, because we are shorting these contracts, we're writing them, we're selling them, it means that we want to sell high, buy low. So volatility increasing whilst we're in a position will have a negative effect on our P&L, and we also want to come down here and filter out anything that has a low liquidity rating level. We are only interested in trading liquid markets, tight spreads, and that's going to give us that's going to allow us to keep the most amount of profit possible. The spread is what you pay every time you get in and out of a position, so the tighter the spread, the less you pay. Now you'll be left with a watch list that looks something like this. This is a pre-made watch list. You can use any watch list that you like, and I simply like to order it from high to low in terms of IV rank. Again, going back to the volatility point, we want to sell high, buy low. We want to sell when implied volatility is high, and then buy it back after the contraction. Now, this is a pre-made watch list. You can use any watch list that you like. We're just going to go to a high options volume watch list. And at this point, we just go down the list and see what would fit well inside of our portfolio. You want to make sure that everything, whatever you decide to mock up a position on or send an order for, you want to make sure it's going to complement your portfolio. Use common sense. If you're very heavy in a sector, don't look for more positions in that same sector. Try and stay nice and diverse. And we're just gonna go with, let's have a look here. We've got GLD, we've got Beyond, we've got TLT. Let's have a look at TLT. It's trading at just over $87. Obviously, with it being New Year's Day, the market's not open. It says the market's closed, but it says the market's open here on the platform, but it's not. Anything that is open, futures might be open, I'm not sure, but there will be basically just no volume. No one's actually going to be trading today in terms of the big money. So for all intents and purposes, the market's basically closed. So we're just going to mock up a position. We're not going to send any orders to try and get filled today. But we're going to have a look at TLT with an IV rank of just over 41 and an absolute IV level of 16.3%. TLT is the 20-year Treasury bonds. So we're just going to navigate over to the trade tab. We already know where we're going to be. 51 days out in time, February 21st. And this is now the options chain. We have a horizontal orange line that shows us the price of TLT with respect to the strikes, and we have a vertical orange bar that shows us the expected move of TLT over the next 51 days. So we're going to be writing contracts or selling contracts, which means that we don't want price to go anywhere near our contracts. We don't want price to breach our contracts, our strikes. Now, we also want to make sure we have a high probability of success. So how do we do that? Well, we know what the expected move is, and we know that we don't want price to go near our strikes, our contracts. So we're simply going to sell contracts outside of the expected move. How far out do we go? Well, we've got our blue 1 standard deviation, 2 standard deviation lines here, and we want to be around the 1 standard deviation mark, and we also want to be between 15 and 20 deltas on the delta column. So if we look on the call side, we've got a 17 delta here at the 93 strike, and on the put side we have a 17 delta again at the 83 strike. So essentially what we've done is we've created a range between 83 and $93, and that's essentially the entire position. Now if you look on the left, you'll see this green bar. That's our break-even bar. So if price lands anywhere within that green bar at the point of expiration, then we'll make money. And as you can see, the green bar overshadows the orange expected move bar, which is going to lead to a high probability of success. So if we look in the bottom left corner, we have a pop of 72%. Pop is probability of profit, and that simply means the probability of making at least 1 penny on this position at the point of expiration. However, if we don't want to hold till expiration, we can get out early at say 50% of max profit. And as we can see here at P50, we have an 86% chance of getting out of this position at 50% of max profit at some point over the next 51 days. So we're looking at probabilities of success between 72 and 86%, which is extremely high, and that's very good for us. We will collect 95 cents up front of premium. You multiply this out by the contract multiplier. For equities, it is 100. Each contract controls 100 shares of the underlying. That gives us a max profit of $95. We technically have an unlimited loss potential. However, as long as you know how to manage risk, you won't ever take an unlimited loss. Our broker is going to require just over $1,300 in buying power to open this position. Now, that gives us a respectable return on capital with high probabilities of success, especially with it being a naked position. However, I did mention that I'm going to show you how you can find positions for smaller accounts as well. 1.3k might be too much for you. You might not like the unlimited loss potential. I'm going to show you what to do. So what we want to do is simply just come out, say $2 wide. That'll land us at around the 10 delta at the 95 strike. So $2 is a $2 wide spread, and we're going to do the same thing on the put side at $81, which lands us again at around 10 deltas. So we've created a $2 wide spread on either side. And what this has done is it's given us a defined risk. It's no longer an unlimited loss potential. We've defined our max loss, and it is defined by the distance between the two strikes, i.e. the spread, which is $2 minus the premium that we collect, multiplied out by the contract multiplier. That gives us a max loss of $158. Now, the premium that we collect up front is less because we're using some of that premium to buy the long contracts to cover our short contracts. But what that's done is it's given us a defined max loss, and our broker knows what our defined max loss is, and so it's only going to need to hold that much in buying power, which is $158, as opposed to 1.3k. So as you can see, our max profit is 42 and our buying power requirement is 158. This is now a much higher return on capital than the naked position. In exchange for this higher return on capital, we do have slightly lower probabilities of success. This is just because nothing is free in the market. To get something, you have to give something, and that's essentially the trade-off. You can manipulate this position further. You can go even closer and require even less buying power. You can move your short strikes in, be more aggressive, collect more premium, get a nicer return on capital, but in exchange have lower probabilities of success. But generally speaking, this is what you do. This is how you can find and manipulate positions to fit inside your portfolio. Now, how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template that's available for everyone to copy and get and make their own. Link will be in the description. Just click on this button and it will take you to this spreadsheet. And the way it works is you enter in the size of your portfolio, and then below you will enter in the current VIX level, and everything will then be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to a single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And as long as you follow this spreadsheet, over the long run, you will be absolutely fine. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you will have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making all in real time. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. If you get stuck, you can speak directly with myself or with other like-minded individuals. It is a private community, and there is a 100% money-back guarantee. So after you've been inside for at least 6 months, followed our trades, gone through the course, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's £1 a month to join. The price is so cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to get you to a point where you are completely self-sufficient. You know how to write options contracts. You know how to manage risk. And you've learned the skill, and it's something that no one can take away from you for the rest of your life. And we aim to get you to that point within 6 to 12 months. You are always welcome to stay and be a part of the community, but 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.